Hello, everyone. Thank you very much for joining today's webinar, and it's termed Financial Independence Retire Early. And for those of you listening live, today obviously being Thursday, the 3rd of October, just 2 days after the recent budget 2025 that we had. So I know many of you have been listening to some of the webinars that we've ran, and they are available to listen to on our website, Alpha Wealth. They are all free to download. There's no compulsion to take our advice, of course, but we do feel that there are some really good takeaways and things that will help you financially. And today's focus is primarily going to be geared towards how can you retire early, which I think is something that all of us can strive for. For those of you not familiar with Alpha Wealth, we're a progressive financial services company with 10 advisors based in Cork and Dublin. And I would encourage all of you just to think about, have you had a financial review in the last couple of years? It is really worthwhile speaking to a independent financial advisor. And I know it may seem maybe something that you're not in a position to do, maybe because you don't have the finances, but we deal with all different types of individuals. And I really feel there's so much value that you can get from having a discussion in any areas, whether it's related to a mortgage, your pension, savings, getting your money to work harder for you, reducing the cost of insurances, and so on. So today's webinar, and I'm joined by my colleague, Clean O'Donoghue, who's going to be looking after questions. And if anyone would like to ask any questions, please do pop them into the Q&A. We do want to make sure that we can add as much value from this, and we will be addressing some questions that we've had over the coming weeks. This being the second of a series of FIRE webinars. We did one earlier in the year, which again is on our website. But I want to focus on what is financial independence, how can you achieve that whilst also satisfying your other financial goals and priorities, and giving you the best tips in order for you to do this. So getting straight into it, and I'm going to just touch on the budget from 2 days ago. I know some of you maybe listened to this recorded, and we did get an announcement, most of you are familiar with it now, where we're all going to be roughly better off by 100 to 150 euros a month. And depending on your situation, obviously, if you have children, slightly better off. But the key principle of FIRE is about making the money that you have available to save work harder for you. Some cases, it can be a little bit more extreme in making sacrifices, but that's not really the key theme of what I want to get across today. I'm a great believer of people meeting their financial objectives, but doing it in the most proficient way. And I refer to this kind of roadmap and making it the straightest line possible. We did have some articles published on financial independence. We can provide them to you, and we are happy to share the video and indeed slides and some links. My colleague Clean is going to put up a few links into the chat function that I think would be useful in terms of takeaways today. But financial independence really refers to three things. Firstly, it's being debt-free. Very difficult to be financially independent if you have debt. The second thing is having assets that provide an income stream, this passive income as we refer to, such as a property or pensions or a combination of those, that gives you that ability to effectively not have to work for financial reasons. Some people think that financial independence is retiring, and that's not typically the case. I always say when I meet somebody, tell me when you would like to be in a position to work less or semi-retire or indeed retire fully. And then we show them a projection based on their current assets and what is likely to actually achieve for them. And we then make suggestions, and I think it's really important for people to redress their plans generally once a year to just keep a checkpoint. And I'm going to refer to this later on. The other thing, finally, then on financial independence is that you have to have all future expenses allowed for. So you can become financially independent, semi-retire, even if your kids are still going through the college age or living at home, as long as you've made provision for their financial requirements set that you feel. FIRE started back in the 1990s in the US, and you can read a lot more about this separately, but in essence, it's really saying that if you strive to make your money work for you, you can retire early. In its real pure form, it can be seen as quite extreme. this notion of what they call fat fire is for those people at a young age who commit a large amount of their income to savings, potentially up to 70%, which is the extreme part, where you could retire from some time around your 40s. Now, personally, I think the earliest that we should try and achieve FIRE would be at 50. That's because that's the first time that we can access our pension scheme, which will be a large part, in my opinion, of the ability to do this. I'm going to focus on kind of 55 generally. That tends to be the sort of the age of which we realistically aim for most people. Now, some people on this call may feel that that's totally unrealistic. And depending on their age, it might possibly be. I'm 51 actually in November of 24. And I am striving for financial independence at the age of 60. And I can explain to people in more detail as to why I have 4 children, a blended family. I've started my own business just over 10 years ago. And I'm allowing for the things that I want to achieve before I do that. And essentially, it's about trying to get to a position where I'll feel comfortable to be able to retire. There are
So
other.
Nick, you mentioned, sorry, there earlier just about somebody maybe accessing their pension at 50. And are there any tax implications for somebody who is looking to retire at 55 and adopt one of these FIRE approaches?
There is, because tax is a massive issue for all of us. Okay, it's the biggest expense we're going to pay in our lifetimes. For anyone earning over 150,000 a year, if there's a couple that bring in 150,000 gross into the household, the tax man takes over a third of that. It's really, really obviously excruciating, and it's a big drag on being able to, retire early. So the point being is that one of the main things that we do as financial planners, and this is David Looney and myself primarily in Alpha Wealth, there are other people that work in that regard, but we essentially help people understand about mitigating the tax that they pay, not just now, but also in their later years. The big issue for some people is that they may not realize it, but they can actually take advantage of more tax efficient instruments to reduce the tax that they pay now, but to put them into a better position to pay less tax again in the future. And I'm going to touch on this in a moment, but it definitely is something that people should have some regard to. Just in terms of slightly misfocused around the fact that they just think that this is just a notion and it's not really feasible in their situation. They may have debt. They may be trying to embark on buying a new property. And this is kind of the last thing on their minds. And all I say to them is that you just need to think about your financial position and do the best you can with it. For anyone that's listened to any of the previous webinars, and again, there are many of them available on our website, there are some upcoming as well, which I'm going to mention later on. But the key point is start with what I call the financial budgeter. It is the key to success. Might seem very simplistic. You may do something like this, but you can download this for free on any of the kind of websites out there. We have one on Alpha Wealth. I think it's a really good one. You can access it through the QR code there on the screen, or indeed just type Alpha Wealth into the Google search engine. And by doing this, it will give you a really good sense of what money comes into your household and where is it going. And the key point of this is just to try and get a sense of understanding what are those expenses that you can reduce. I say to everyone, don't pay 1 cent more for any insurances that you pay for. And it's not really necessary. We come across a lot of people that spend way too much on insurance and not enough towards certain things that they want to try and achieve, like getting a deposit for a house, or indeed saving for their kids' education or their retirement. And it's about finding the right balance. Other things like paying for your mortgage, which tends to be one of your biggest expenses, or indeed rent, and helping them to try and mitigate the cost of that, which we do independently in Alpha Wealth. We do not provide mortgages, but we give very good mortgage advice to people. And by doing so, you
So
can
Nick,
get a
on this
sum.
again, sorry, just to jump in on this and on the budget calculator and looking kind of at monthly expenses. So if you're looking to retire at 55, how much of your income should you be putting aside each month?
In general, I would suggest typically about 20%. And that might seem like a lot to some people. And it may seem like a notion that, that's not possible. it doesn't really matter how much you put in, guys. It's about the focus, and it's about thinking to yourself, okay, I talk always about these three different pots, buckets, call them what you will. And all I'd ask you to do is just once you've done the budgeter and you've got a sense of what money you have available, save it first and then spend whatever else is left after. Don't do it the other way around. And in doing that, think about your short-term goals, which is anything less than 3 years, your medium-term goals, which is typically 3 years to that age of what I called financial independence, which is generally 55, I would like to think for some people. And then what is the long-term aspirations? And bearing in mind that we spend roughly about a third of our lives, particularly if we're trying to retire early, in that sort of post-work environment, it needs attention. But it's not about saying, well, you should be doing this and you can't afford to do so. It's about helping you to release the money that you should be able to create. I said earlier about, the budget giving us back roughly 150 euros a month on average per person. We all benefited from the last budget back in January of this year, which is when the effect took place. And most of us didn't realize or didn't take any countenance of that. And I suppose the point being is that don't let this lifestyle creep kick in. Use that money and put it towards which of those pots is most important for you. If you have a requirement to save for a new car, for example, ideally, you should be using your own money, preferably not to take out loans. I'm a big advocate for only take out a loan if it's absolutely necessary. And the one that it certainly is for most of us is for buying a property. But a lot of people I come across have loans that they've kind of allowed into their financial budget. And the biggest problem I have with the loan is not just the interest that you pay, but the fact that it takes money off your ability to save into something else.
So 2 questions before you move on, Nick. Just
Yeah.
Firstly, there was just a question in, is the 20% of gross salary or is it off the net?
Either or, but typically gross should allow you to achieve the various goals. Now, again, it depends on what your specific situation requires, but maybe if I can show you just a very quick example of how effective planning can be. And we talk about the concept of compounding. It's where you're earning interest and it's accumulating over time. Now, I'm not going to get into jargon today, but just to take this one big concept away, let's say bring you back to your 25-year-old self, or if you happen to be younger than 25 or 25 today, think about the fact that you could become financially independent at 50 by saving 300 euros a month. Now, you might scorn that and say, how is that possible? And if you look at the example on the screen there, Anna saving 300 euros a month, it's going into a pension, but that doesn't matter. A pension is just a long-term savings account. Because she's a high rate taxpayer earning over the 44,000 a year that the threshold would allow her from January, she's going to get 200 euros added by the government. And her employer is giving her a matching contribution. And again, for anyone who's not in a company pension arrangement, they're going to benefit from the fact that the government are introducing this auto enrollment scheme in September 2025. That has been clarified and has been set in stone now in what will be in the Finance Act in the next while. But the point being is that this cost of 300 euros will give Anna conservatively a fund of about 800,000 euros, which will effectively provide her 200,000 tax-free and an income of about 48,000 a year. And for most of us, that will be sufficient to provide us a lifestyle that will be reasonably comfortable. And bearing in mind that Anna will be entitled to the state pension in Ireland, which is quite generous. We only need 10 years full contributions, which will be about 14,500 a year from the age of 66.
So Nick, on that, what pension fund would you need to have to retire at 55 or 60? You mentioned 800,000.
Yeah, honestly, for me, anybody that gets to 800,000 in an independent pension fund can retire. And I've just proven that by saying to you, surely 200,000 in cash in your bank with 48,000 a year, for most of us would be quite sustainable. The reason being is that we don't want to earn a massive income in our retirement years because you end up paying a lot of money to the tax man unnecessarily. And again, if you're in a situation with a partner, hopefully they may be able to build up something of a pension pot themselves. You may have some other assets and so on. So that to me, now, bearing in mind the state pension in Ireland that, again, sometimes people are not really aware of, is worth about 250,000 euros to most of us. If you add up the 14,500 a year from the age of 66 to something in your early 80s, which is hopefully the age that most of us live to, you'll obviously easily understand that that's worth around that sort of figure.
So before you move on from this slide, there's just one or two questions. So let's say Anna gets the 800K, or sorry, has a pension fund of 800K, gets 200K, lives for 2 years. Who gets the balance? Will the pension continue to grow without any additional premiums?
It will grow without further premiums. Anna cannot put in more money. She doesn't need to. She can if she has another source of income. But the fund, what's left over in this example, 600,000 will go to her estate. Pensions don't die with people. They used to, they don't anymore. So the fact is, it's an asset. And if Anna doesn't take out more than the 48,000 a year, by the way, she's not going to spend all of that money in her lifetime. Some of that money will pass to her estate. People underestimate the benefit of pensions. And again, today is not about specifics on pensions, but it is one of a big part of a vehicle that I would use. And if there's one thing alone that I take from today's session is take the opportunity now. If you listen to this call in the month of October or early November 2024, to make a contribution into your pension scheme to get tax back for last year. And to give you an example, if you put in 10,000 euros into a pension scheme, make sure it's the right pension. And again, it would be worthwhile getting independent advice from a financial advisor. But you will get 40% back from the tax man immediately. That's 4,000 euros. The other way of looking at it is saying that if you contributed 6,000 net, that will gross back up to 10,000. That's a 66% boost we take. And if you look at the table on the left-hand side at the bottom, depending on your age, you can see how much revenue will allow you to put in, not just for this year, but for last year. So if you're in your 30s and you're earning, say, 50,000 euros, you can put in 10,000 euros for last year and 10,000 euros for this year. And you've got typically a few weeks to make up that provision if you want to go back for last year, depending on when you listen to this call.
So what about somebody that doesn't have a company provided pension? This person has said they're not interested in going for auto enrollment. Can they opt out of the auto enrolled pension scheme?
Yes, you should opt out of auto enrollment. We're not big fans of this. We've done a couple of webinars on it already. In my opinion, everybody should either get their company to allow them to make a provision into a company sponsored scheme or set up a scheme separately. Now, again, I can give advice specifically on that. And I would suggest that if that person wants to reach out to me, I'd be more than happy to do so. I should have mentioned as well, for those of you that joined late, please do feel free to pop any questions into the chat. And if anyone wants to ask,
Nick, there are a few questions coming in, just particularly on this slide. So I'm just gonna put them to you before you move on. On this slide is the percentage of total pay excluding your employee contribution, i.e., if you're age 21, paying 5%, company matching 5%, can you as an individual still max out your ABCs?
Yes, a lot of people get confused that if their company is paying into the company's pension, say 5% of salary, that encapsulates the 15% for a 20-year-old or 20% of the 30-year-old. It doesn't, guys. So if you're earning 50,000 and you're aged between 30 and 39, it's 10,000 a year that you can contribute. And this is a key point that's missed. The other thing about company pensions, and it doesn't matter if it's an old company pension. A lot of people forget about schemes. I often talk to people and they say, oh, I've got a couple of €1,000 in Acorn or Irish Life from a previous employment. And I say to them, like, you need to look at or get somebody more correctly to look at this. We'll do that for you and make sure that you get the most benefit from it.
And just before you move on, I'm going to actually, there's loads of questions coming in and I'll address them at the end. But just on one thing, on the tax relief, is that refunded back to you from the government or is it added to your pension pot?
It's refunded directly to you. If you put in 10,000, guys, and if you do it through ourselves, I'll get you 4,000 euros back within 2 to 4 weeks, I assure you. There's no drama with it and it should be quite straightforward. And we can show you either indirectly or directly the best way to go about doing this. But you need to think about, where is your pension invested? What funds are you invested in? Are they appropriate for you? This is not just about sticking money into your pension. It's about getting advice. It's about having a financial projection. This 800,000 figure that I mentioned earlier, you need to find out what your projection and trajectory looks like, and we'll do it for you. It's a really powerful tool, and then reassess it every year, generally through a financial broker that can show you how you can make improvements and adjustments that will suit your needs. Many people, may have set up a company. We're doing a separate webinar on the 14th of November for business owners. Obviously, I'm a business owner myself. There's so much value in just getting advice, and I can't but encourage you to get that. Don't think that by me talking a little bit today about putting money into your pension, that's where it ends. It's kind of where it starts. You need to identify what your financial goals are, how to get your money working. This is really only one small part of that. For example, if anyone has worked in the UK for 3 years or more, please make contact with us. We will show you how you can benefit from getting the UK state pension. You're going to have to apply. You use one form. It's really simple. It's something I've done myself. Some financial brokers are charging thousands of euros for this. If you email me, I'll tell you how to do it for free.
In terms of
Okay.
savings, Nick, somebody has
Yep.
said, I assume not in the banks, given the interest rates versus inflation rates. So can you?
Yeah. Just going to come on to that. You can save in AIB Bank of Ireland monthly. So for any new savings, and all of us should be doing this, every one of us can afford to save 10 euros a month, surely, for our short-term needs like Christmas, holidays. If we want to fund something in the next 3 years, do it with AIB Bank of Ireland, but make sure you do it with the online saver, 3% fixed rate, and clean it out every year, because if you don't do that, your rate will fall. However, if you've got money, let's say that you've accumulated and it's sitting in AIB, that won't attract the same rate of interest. My solution is look at some of the online banks. Personally, I use Trade Republic. It's a better version than Revolut. Revolut have been really clever about the way they've advertised savings. You can see it on the screen. They talk about 3.49%, but in order to get that, you have to pay them 55 euros a month. You can get 2% from them without any fee. Some of their flexi cash funds offer much better rates, but then you're starting to move into exchange rates risk, which is dollars and pounds, which I wouldn't encourage. And even their euro rate offers a very unattractive net return because the tax on it is unfavorable. Look up Trade Republic, guys. Again, I've got no bias in this, but you can get 3.5% gross interest with 24-hour notice money. There is no need for you to keep any real money in your current account. And certainly if you've got any money in the credit union or post office that you need access to in the next 1 to 2 years, look at other alternatives. Credit union, I really am struggling to understand why people keep saving with the credit union. Their dividends are zero. They're telling you they do not want you to save with them, and people yet continuously do so. It really doesn't make any sense.
And what about Bunk, Nick?
Bunk are fine, but they're not as good as Trade Republic. Their rates are lower than Trade Republic's. Trade Republic's is best in class. And one of the key things, as I said earlier about FIRE, is do the best you can with your money. Now, I'm not totally against Bunk versus Trade Republic, but it's not the best. The best is 3.5% gross interest, no fees, and up to 50,000. My suggestion is Trade Republic. It's a regulated institution. You can see that your funds are legally protected up to 100,000 per investor, but the cap on the 3.5% is on 50,000 euros. However, putting money into Trade Republic isn't the solution either. That's only for short-term needs. If you need money in 5 years' time or 10 years' time, let's say for your kids' education needs, don't leave it in the bank and don't put it into Trade Republic. It's not the right place. Look at alternatives. We talk about the Alpha Savings Club. This is a savings account that we have basically devised for people looking to save for 3 to 10 years plus. And I use it myself. Our current provider is Zurich. We have the ability to move providers to get the best returns from the best companies. The key point is that it's offered at the lowest fees. Some people may have set up these accounts with other providers in the past. You need to find out what fees you're paying and get them to an absolute minimum. We provide 100% of people's funds to be invested. and we give advice and guidance on an ongoing basis. I'm going to touch on a lump sum opportunity for those people who are high rate taxpayers. There's a government-backed scheme. This is the second of two things that you can do to reduce tax. One of them is put money into your pension. The second one is through a scheme called the Employment Investment Incentive Scheme. I'm not going to spend too long going through this, but again, we can forward on more information. There are two companies that I can give you information on. One of them is based in Cork. Basically, it's a roastery. They're selling a coffee called 5 Mile. It's a fantastic opportunity, in my opinion. They are finishing off on a raise of funds, which will incorporate both a restaurant and a bar alongside the 5 Mile coffee brand being sold across the country, and is being managed by a company that own and manage a number of hotels, bars, and restaurants of the country. The second one is a renewable energy fund. This is an investment opportunity. And basically the way EIS operates is that you invest a lump sum. You may have some money sitting in that credit union doing nothing for you over a minimum term of 4 years, typically tending to 5, and you will get back tax relief, typically at 35%. It's 3,500 for a 10,000 contribution. And after 4 to 5 years, you would get expected your money back plus a return from the company that you invest with. There is risk before anyone asks me with your investment. You are lending money to an Irish company. The key point is to make sure that you get appropriate information and advice. And obviously through an advisor like Alpha Wealth, who have no bias, I'd like to think that we're in a really good position to be able to assist you. For anyone who buys a Sunday business paper, in the months of October, November, we'll see many companies advertise for EIS finance. I would tread very carefully. There's a lot of companies that I certainly wouldn't consider investing in. Okay, moving on. So I think you've got the idea about making your money work harder for you. There are a lot of people that ask me about what's the best investment out there. Should I invest in shares? I get company shares. Should I sell them? Should I keep them? I'm not sure what to do. The key principle is make sure that you diversify your investments. I really have a problem with a lot of people who work for companies that receive shares. I've done a lot of financial reviews with some of the big companies like Lilly, Google, and so on, where my first approach is, how many shares do you have that you could sell? These are what are known as vested shares. And make sure you keep it at a level that should make you less uncomfortable. And what I mean by that is that if you've got, say, 50,000 of company shares and you've got no other investments, that is absolutely disproportionate. I don't care how good you think the company is. It makes no sense from a risk perspective. And the key point is that you cannot argue that that company is the best company for you to have your money with. It's not, honestly. I'll give you other examples of companies, respectfully, that have outperformed Lilly and Google this year. I'm not knocking those companies. The point I'm trying to make is make sure that your money is risk appropriate, that it's proportioned correctly for what you need it for. Depends on how long you want to invest for. And also that it's in the lowest fees in the right type of instruments. A lot of people ask me about exchange traded funds. They want to be the kind of, I want to do it myself investor. They don't realize that the tax treatment of those is quite unfavorable. It's a 41% tax rate. It's taxed every 8 years, whether they take it out or not. And it's typically not diversified as much as they might think. So I would warn people just to tread carefully. Look at opportunities like your pension. Look at the likes of EIS. Look at more diversified type investment options. We sometimes talk about property. You know, I find that a lot of my clients are really interested in buying a property because they think the property market's so safe and we have a property crisis in Ireland. I'm not saying property is a bad investment, but what I am saying to you is you need to be mindful about what is it that you're aiming to achieve. Because we all think that, you know, we buy a property for, say, 250,000, we rent it for 1,500, 2,000 a month, and we're doing really well. But you need to look at, you know, the exposure of that property. You know, the fact is tenants have rights in Ireland. What is the tax implications for me? If I'm a high rate taxpayer, the government are going to take 50% of that rental income I'm going to get. You know, you need to be cognizant of how you're going to, you know, use the money. And really, the fact is it right for you based on your position? And this is where the advice piece comes back in. Okay, I just want to sort of bring it all together. I'm not sure if there's any other questions, Clina, that you want to mention.
But I'll leave them till the end.
Okay, so just to mention, FIRE is about focus. I think I've made it very clear that it doesn't necessarily mean making sacrifices. It means being on your front foot. deciding what it is that you're trying to achieve and helping you to do so. That one projection that I spoke about that we provide to every person that signs up for a consultation with us, in my opinion, is the most powerful document that you can get. Doing simple things like the financial budgeter, not overspending on things like insurances. Anybody that's spending more than 25 euros a month on mortgage protection, which is a policy that you have to buy when you take out a mortgage, is spending too much. And again, I would encourage you to reach out to us and we can show you how you can reduce the cost of these types of schemes. Savings, get your money working. I've spoken about Trade Republic. I've spoken about AIB Bank of Ireland Online. I've spoken about the medium term Alpha Savings Club, the EIS scheme. I've only touched the surface, guys. And again, I think it's really important. Make sure that you speak to somebody and get proper advice. Don't do it yourself and think that you're doing the best thing possible. Reducing debt. Debt is a really good savings plan, by the way. If anybody has a loan with the post office, credit union, or may have a credit card debt, my suggestion is that you should focus on that first. And I talk about a concept of snowballing, where you focus on the smallest debt, pay it off, then put it to the next debt, and so on. We can help you in terms of reassessing your goals. Reducing the tax you pay. Again, I've given you some examples of how you can do that. Pay into your pension for last year. Look at the likes of EIS. Are you funding your pension enough to get to what you want to? Is it appropriately invested? And then it's a case of just revising that and making those changes in those three different pots that I spoke about. Okay, redundancy. I know sometimes this can be, sort of a very touchy subject, and unfortunately some people are, I suppose, at the fear of being made redundant. My colleague David is going to be doing a webinar on the 15th of October at 7 p.m. where he's going to, if you're in any doubt about the fact that you may be made redundant in the future, talk about how to navigate best and not make the wrong decisions at that time that will cost you tens of thousands of euros. I myself are going to do one in November, on the 14th of November, for business owners specifically. As business owners come towards their year end, they have an opportunity to reduce the tax that their company pays, but also they pay. And again, anyone that's on this call who is a business owner, I would encourage you to register for that webinar. And you can do so again through the QR code on the screen or through our website. Please go on to Alpha Wealth. There's some really great tools and there that you can use and download for free. And finally, just before we get to any further questions, I just want to mention we provide a financial consultation review for people. It's a really good process. I think I've touched on how people can benefit from that. I know some people are listening to us now who have done the review with us. I know some people are thinking about doing a financial review. We have a fee structure. Now, the fee is 199 euros. It's what we call our core review. And for those people earning over 100,000 or a couple over 150,000, or indeed any business owners, that review is 349 euros. We are providing a discount of 50 euros for that platinum review until the end of October. And the code to use is platinum 50. Now, if anyone, as I said earlier, has any questions, please email us and we'll answer them. But if anyone is looking to really get a hold of their finances and take advantage of those opportunities, we can help you with your mortgage independently. We can help you get assessment of your pension, reducing the cost of insurances, getting the most out of your savings. And many of these things we do not sell. We are looking to give you advice, and that is a once-off fee, and there are no further fees or payments you make to Alpha Wealth at any stage in the future. And I think it's really worth, obviously, exploring for those of you that haven't benefited from a financial review with us in the past.
So lots of questions coming in. You just mentioned reducing the cost of insurances. So the first question is, are we paying too much in insurance? We're paying 195 euros for 3 people per month with Irish Life medical insurance. Me, my wife, and 4-year-old child. What do you think?
I think you should get us to review it for you. Again, without bias. The reason being is that it's very difficult for me to say whether it's too much. It seems like a lot per month. But the fact is, I need to find out a little bit more about why you're paying for health insurance, particularly do you require outpatient benefits like claiming back for things like GP, physio? I myself have a plan with Leia. I have no bias, obviously. I think Leia makes more sense for those people who are under 55 living outside of Dublin. But again, we can give you specific guidance. But the point being is, if you book in for the financial consultation, we will tell you exactly what plan we think you should be on and advise you alongside all of the other things that I've spoken about today.
So just on the whole kind of area of savings and saving in the foreign banks, firstly, there was a question in around kind of the dirt tax. Is it taken off by the foreign bank or do you have to pay it? And then there was another few kind of comments came in around kind of the credit unions. If the credit unions provide cheaper loans based on savings and there's no harm in having some money in the credit union in case of emergency. Maybe you'd just like to discuss that.
You need to declare the tax on the foreign banks. It's so easy. Use the Ross system. One of the things I'd encourage all of you to do, and I did a webinar recently about 4 ways to reduce tax. Anyone who has an interest in it, please do listen to that webinar where I go into a little bit more detail on the areas that I've talked about today. That's so simple to do. It's 33% obviously tax that you pay off the rates that I quoted earlier. In relation to sorry, Clea, what was the second question?
So the second one was around having money in, like some people have said
Yeah,
that the
credit
credit
union. Sorry,
union is a good place to have money
it's not a
for
good place to
savings
have money.
and loans.
They pay 0% dividends, guys. I've just given you an example of how you can get 3.5%, and you can do it from the use of your phone at home. Talking about these cheaper loans, the credit union loans are not that cheap. The rates that they quote are around 7-8%, and people think that they look after you because you're a depositor with them. Those days are gone, guys. Honestly, I can't encourage you enough. Firstly, we don't really want to be taking out these loans too easily. That's the problem. They want you to take out the loan. But the thing is, you can get a loan with any institution, and I can give you examples of cheaper companies that would offer you a loan. But with all due respect to anyone who has money in the credit union, why would you leave money in at zero when you can get 3.5% for 24-hour notice? It is not sensible financially.
In terms of crypto, yes or no?
No, it's too
Okay,
risky,
why?
guys. It's too risky. Like crypto isn't something that people should dabble in. Now, if you want to throw a couple of €100 into cryptocurrency and let it sit there, that's okay. That's not part of an investment strategy. You know, we talk about not being speculators. Everything I've spoken about today is not about speculating. It's about putting proper financial plans in place.
For somebody that can't get access to a company pension till they're 60, is investing in a new scheme possible with a view towards accessing it earlier?
You can access company pensions from the age of 50. So I'm not sure why this individual said 60, but
Can't get
it's
company pension till 60. Maybe, I don't know.
yeah, I think that's incorrect. But again, I think in that instance, please send me an email and I can give you more specific guidance if you give me a little bit more detail. But again, I can help you in terms of understanding how to access pensions. A lot of the legacy pensions, by the way, guys, if you've got a company pension scheme from a previous employment, you can get that money at 50 years of age, and in some cases tax-free. It's worth noting that if you have certain objectives that you want to meet in your 50s, potentially that would be an area to kind of go looking for. And again, more importantly, get a financial broker to do on your behalf.
I'm just looking through because there's been loads of questions that have come in. I think there was just a comment as well on kind of accessing loans. This person said they got a 40k loan from the credit union in 3 days to refurbish a rental property, which was trashed. Bank of Ireland were a disaster for equity release. So I don't know if you have any kind of comment on loans and
I do. Obviously, in that person's instance, they got the loan quickly, but I'd like to know what rate of interest they were offered. And with all due respect, again, there are other banks and institutions out there. The reference to equity release suggests that they were trying to kind of add this to their mortgage, which obviously was going to be a little bit more troublesome, but the rate of interest that they would have got would have been much lower. But the fact is that, again, if we can try and align ourselves to setting out our financial goals and getting that independent advice about which institutions. There are other banks out there that will provide loans very quickly. The likes of Revolut, for example, are offering these loans at a lower rate that I should add than the credit union, and in some cases a lot quicker and easier. So don't get fixated about the past. The whole point is, and again, this is what FIRE really points to, is the ability to adapt, take advice, and act upon it.
any thoughts on investing in EIS-based funds?
Yeah, I spoke earlier about 2 EIS opportunities, but again, it depends on your situation. It's an understanding of the risk. It's understanding what your asset portfolio looks like and whether it's the right decision for you. Maybe putting the money into your pension may be a better one. You need to obviously get an assessment from someone who's qualified, who can help you independently.
I know some people have said that they missed certain parts around kind of Trade Republic and everything like that. A recording will be provided, but this person has said, can I invest in a company pension and then another private pension, or can I contribute to a few pensions all at once?
You can, but you shouldn't. If you have a company pension scheme, and as long as it's a low cost scheme, which typically most of them tend to be, and as long as it gives you options in terms of investing in a variety of funds, take full access and advantage of it. It's so much easier being done through payroll. The only caveat to that is if you're going to make a back payment for last year, it may be worthwhile looking at an alternative because that's a lump sum contribution that must be made separately. And there are providers out there, the likes of Zurich, for example, that have a really great investment management team. And that might in itself give you a bit of diversification. But get advice. I'm going to sound like a broken record here. I cannot but encourage you, sign up for a financial consultation, and if we don't provide value, we refund you the fee. Honestly, I can't tell you how important it would be for all of you out there just to make sure that you have somebody that's independently giving you a proper assessment about how to manage your money.
Just in terms of auto enrollment, why do you recommend opting out of auto enrollment if it's a government pension scheme?
The main reasons are, firstly, if you're earning over 44,000 a year, you'll lose out on 15% tax relief. So nobody that is a high rate taxpayer should be auto enrolled. The second reason is that auto enrollment can only be accessed from the state pension age, which is 66, all other company pensions from the age of 50. The third reason is that auto enrollment allows for no investment decisions. Other company pensions do. I wouldn't feel happy or comfortable with having my pension fund being managed by 3 different pension providers where I had no choice of where it went. So hopefully that answers that question.
And I've just got 2 last questions. The next one is, you get tax relief on pensions, but you do not pay tax on the way out when you retire. So, or do you not pay tax? Sorry. So can you just kind of elaborate on that question?
You do. Some people say that pensions are just a tax deferral, and I totally refute that. And the reason is that you get typically 40% tax relief at the outset. The money grows tax-free, that compounding growth I spoke about earlier. For all the years that it sits in the pension fund, it isn't taxed. And then at the end, you get 25% of it tax-free. The remaining 75%, you typically draw at the lower rate of tax. And for the money that sits in that fund post-retirement, that 75%, isn't taxed while it sits there. Pensions are not just tax deferral, and they are the best opportunity for people to reduce the tax they pay.
And lastly, and there are still kind of questions coming in, but we'll leave the Q&A open for any kind of questions that you still want to ask. Do you trust the foreign banks like Revolut over the Irish banking institutions?
Yes, I do. That's why I mentioned them. I use Trade Republic extensively. I have done for the last year and a half. Guys, these foreign banks are safer than the Irish ones. I can show you through Raisin, who are regulated German bank, offering you all of the rates through the different financial institutions, most of which are much more superior in their credit ratings. They're basically their security than the Irish ones are. There's a Swedish bank called Carna, AAA rated. It's the strongest bank in the world, offering 3.4% over 12 months with a government guarantee of up to 100,000.
I'm also just going to share a link to our new podcast for anyone that wants to check it out, and also just links to our social media channels as well.
Great. Listen, I really appreciate your time today, everyone, and thanks so much again. Please do look out for future webinars. Please do think about booking a financial review. And obviously, again, if anyone has questions, please feel free to drop an email into info@alphawealth.ie, or indeed myself, Nick at Alpha Wealth. Myself and David are available. And honestly, we do feel that there's a huge amount of value. And so much again for your participation today. Thank you.